The most confusing retirement account gets to keep that title for at least another year. And yes, we are talking about the Inherited IRA. Now, inheriting anything means that you've lost someone close to you, so on top of dealing with your loss, you also have to deal with the complexities that come with an inherited IRA. Now, there's so many questions that people have when inheriting a retirement account, with the big one being, do you have to take required minimum distributions from this account? And for the second year in a row, the IRS keeps thinking about changing the rules on whether or not distributions are required, all while leaving account holders hanging in the balance, wondering what they need to do to avoid possible penalties. So in this video, we are going to break down the most current rules for inheriting an IRA, the latest updates from the IRS, and what you should do if you inherit an IRA. So for those who are new to the channel, welcome. I'm Jonathan Rankin, the founder and CEO of Theorem Wealth Management. We are a retirement planning focused firm, and I've been helping people plan and execute their retirement goals for going on 20 years now. So welcome to the channel. Make sure you hit that subscribe button so you don't miss any of our retirement planning videos. And you're going to want to make sure to subscribe to our weekly retirement newsletter that you could do in the description below. Now, before we jump into the latest updates on the distribution rules for inherited IRAs, let's take a step back and recap what got us here. So in 2019, the Secure Act was signed into law, and that law changed many of the rules that apply to IRAs and other retirement accounts. But the biggest impact came with the changes to the distribution rules for inherited IRAs. You see, before the Secure Act came into play, people who inherited a retirement account were mainly split into two groups, those called non-designated beneficiaries and the others known as designated beneficiaries. Now, the main difference between these two groups was how long they had to take out the assets from the inherited IRA. Before the Secure Act, if you were a non-designated beneficiary, like a charity or an estate, you had to clear out the inherited retirement accounts within 5 years if the original account owner passed away before their start date, which was before the date at which they were forced to take required minimum distributions. If they died after this date, you had between 1 to about 15 years to do so, depending on their remaining expected life expectancy. On the other hand, designated beneficiaries, which includes individuals and certain trusts known as see-through trusts, had a much better deal. See, they can spread out the distributions based on their own life expectancy, no matter when the account holder passed away. So for an adult child inheriting, they could stretch out those distributions over a 30 or 40 year time frame. And if the beneficiary was even younger, like a grandchild, that could take even longer. This was known as the Stretch IRA. But then the Secure Act came along and shook things up quite a bit. And after the Secure Act was introduced, the once straightforward group of designated beneficiaries got split into two. So there are eligible designated beneficiaries and non-eligible designated beneficiaries. Now, if you're an eligible designated beneficiary, which includes groups like surviving spouses or people with disabilities or chronic illnesses, those that are not more than 10 years younger than the individual who passed away, and minor children, you can still spread out distributions from an inherited retirement account over the course of your lifetime. So the stretch lives on for you. However, if you are a non-designated beneficiary, like an adult child, then things changed. You can no longer spread out the distributions based on your life expectancy, and there's a new rule that gives you 10 years to take everything out of the account. Now, here's where things got messy. See, the way the rule was written, many people just assumed that they were subject to the new 10-year rule, that all you had to do was empty the account by the end of the 10th year. Just like an estate or a charity had to clear out inherited IRAs based on the 5-year rule, the way they wrote the new rule, the new 10-year rule, all they did was substituting 10 years for 5 years. So who wouldn't have assumed that you had to just clear out the account by the end of that 10th year? But after the Secure Act was introduced, everything seemed to suggest that the first understanding of the 10-year rule was spot on. Even the IRS appeared on board with that view when they clarified things in 2021, saying that the 10-year rule requires the IRA beneficiaries who are not taking life expectancy payments to withdraw the entire balance of the IRA by December 31st of the year containing the 10th anniversary of the owner's death. So for example, if the account owner died in 2020, the beneficiary would have to fully distribute that retirement account by December 31st of 2030. The beneficiary is allowed to, but not required to take distributions prior to that date. Now, that sounds pretty straightforward, right? Yeah, not so fast. So it appears things weren't complicated enough for the IRS. So on February 23rd of 2022, they issued proposed regulations to reflect changes made by the Secure Act. These proposed regulations suggest splitting the beneficiaries even further. Specifically, they wanted to categorize non-eligible designated beneficiaries based on whether or not they inherited from someone who was already taking required minimum distributions. Now, for those inheriting from someone who died and they were not subject to RMDs, then the rules were pretty straightforward. They just had to clear out the inherited account by that 10-year period. No need to worry about taking out specific amounts each year. So let's consider an example. They just had to clear out the inherited retirement account within 10 years. No need to worry about a specific amount each year. Let's consider this example. Say you were 35 years old and your 69-year-old father passed away. And in this scenario, you are a non-eligible designated beneficiary. And because your dad was not subject to required minimum distributions, you would have 10 years to clear out the account with no requirement of yearly distributions. However, for those inheriting from someone who died on or after this date, this is where things get a lot more complicated. They not only had to follow the 10-year rule, but they also had to take out a minimum amount each year for the first 9 years. And just like before with the Secure Act, at the end of the 10th year, they had to make sure the account was completely empty. This is a scenario we see all too often with our clients. Let's consider this example. You're 55 years old and your 80-year-old mother passes away. Once again, you're a non-eligible designated beneficiary. However, because your mom was taking required minimum distributions, the IRS doesn't want that yearly stream of payments to end. So if these proposed regulations become law, then you'd have to continue taking out a minimum amount each year and make sure the account is fully emptied by that 10th year. In this scenario, that 55-year-old is likely in the process of planning their own retirement, and the timing of those distributions could possibly create a tax impact that really needs some carefully thought through planning. Now, the good news is that these were just proposed regulations. Bad news that made many people concerned was that if it is determined that you should have been taking distributions this whole time and you didn't, that you would be subject to penalties for missing an RMD. Now, at the time, those penalties were 50%. That penalty has luckily been reduced now down to 25% and could possibly be 10% if you correct it in time. So we get to this point where the IRS has issued this proposed regulation and they pretty much scare anybody who's inherited an IRA and hasn't taken out distributions at this point that might be subject to taking them out. And because nothing happens quickly when it comes to new laws, the IRS needed to clarify any potential penalties that someone would be subject to. So instead of coming up with a final ruling, in October of last year, so October of 2022, the IRS waived any potential penalties for missed RMDs from inherited IRA accounts for 2021 and 2022. They said that in 2022, the earliest the final regulations would apply would be 2023, which brings us to now, more than halfway through 2023, and the IRS did the most IRS thing they could do. They realized that last year, they told us that in 2023, there's a possibility that certain beneficiaries may have to take required minimum distributions from their inherited IRAs. And last year, they had people worried and scrambling until they came out with their announcement in October. Luckily, we didn't have to wait as long as we did last year because the IRS just released their IRS notice called Transition Relief and Guidance Relating to Certain Required Minimum Distributions. I know it's a mouthful. Now you might be thinking to yourself, okay, they are finally going to let us know whether or not inherited IRAs are subject to RMDs. Well, not really. Xenos does the exact same thing they did last year. They waived penalties for 2023. I know you're probably wondering, well, what about 2024 and beyond? Well, remember last year they told us that the earliest the final regulations would apply would be 2023? Yeah, well, they just copied and pasted that section into the new notice and changed it from 2023 to 2024. I personally like to call this the kick the can down the road strategy. So how long can they keep this going? Well, to put it in context, the IRA was created in 1974, and it wasn't until 28 years later in 2002 that the IRS finally got around to issuing its final regulations on how the rules for inheriting an IRA account would actually end up. Now, will it take that long this time? I have no clue. Nobody knows. So what should you do if you inherit an IRA, you are a non-eligible beneficiary that could possibly be subject to taking required minimum distributions? Well, the biggest issue that people had with the Secure Act was that the stretch option was no longer there, and the new 10-year rule meant that they had fewer years to spread out the income from their inherited accounts. Which is funny because now the issue is that people don't want to be forced to touch their inherited IRA during that 10-year window. But here's the thing, if you skip taking out money from the IRA in the early years of the 10-year rule, you'll have to take out more in the later years. And for some, like those who are planning to retire halfway through that 10-year period, it might make sense to wait. But for others whose income might stay the same or possibly increase during that 10-year window, waiting too long could mean that you are going to self-impose higher taxes because of the fact that your distribution is going to be that much larger. I mean, if someone waits for 9 years without touching their inherited IRA, they'd have to clear out that entire account in just 1 year, which is the 10th year. And think about it. If an inherited retirement account grows at, let's say, 7% annually, it could double in 10 years. So even a small inheritance could grow to significantly push someone into a higher tax bracket. This could mean losing out on tax breaks, paying more for Medicare, and facing other financial headaches. Now, to avoid these issues, it might be smarter for many to take out money along the way. Take out a little bit each year rather than risking a big income jump later on. So if you know that you are possibly subject to RMDs from your inherited IRA, you might want to make sure that you take out enough in 2024 just to make sure that you're not subject to any penalties. And to do that, you'll want to check the IRS single life expectancy table, which we will link in the description below. This will help you figure out the exact amount you have to take out. You'll use the number related to your age and this year's IRA balance from the end of last year. For example, say you're 50 years old and you've inherited an IRA, and the balance at the end of 2022 was $500,000. You divide that amount by 36.2, which is the life expectancy number for your age, which means you'd need to take out at least $13,812. Now remember, you can always take out more than the minimum amount. In some cases, doing so might even be a smart tax move. And the most important thing that you can do when inheriting an IRA is update your financial plan to incorporate this new account. This is going to help you visualize the tax implications and understand other strategies that you can implement within your financial plan to create the most tax efficient distribution strategy possible. If you need help or don't know where to start, use the link in the description below to schedule some time with a member of our team. And also make sure that you subscribe to that retirement newsletter. We talk about things like this all the time in that newsletter, as well as make sure you hit the subscribe button to the channel. Now, aside from issues surrounding RMDs, there are many other mistakes that people make with their IRAs. And to avoid those mistakes, make sure you check out this video coming up next, where we discuss some of the most common IRA mistakes that are made. I'll see you there.